we're done with QE, right? Like, we've moved on. The debate has moved on to the first rate hike, right?
We're done with QE3, possibly.
Yeah, QE4 maybe further down the road, but that's not the debate of now, is it? The debate now is when do they start, if and when they start raising rates.
Yeah, the debate and the focus will be on the statement, that line, a considerable time, what it even means. We're not going to get Janet Yellen coming out anytime soon and telling us, but it's about whether it
But the
stays
communication
in the
now needs to be refined, because they've got to, because it's
because the asset
time
purchases,
after asset purchases end.
Precisely. As we go forward, here's the bottom line. That line is loaded, and when I say loaded, it is interpreted by the market to mean we are dovish. So you take it away, it almost means we are hawkish, and that means rates are going to rise sooner. I don't know if that's what they intended when that line was first put in there, but they seem absolutely terrified of changing it for that reason.
But at the same time, so we have James Bullard, so he's not a voting member this year, but he was very clear that, you know, maybe QE should be extended a little bit and possibly taken out in December, because maybe we are ending QE3, but we're not normalizing yet. We're just not ready for it.
Yeah, so I guess you're right in the sense that we're not absolutely done yet. We'll know this afternoon whether we're absolutely done or not. And 62 out of 64 people, economists over at Bloomberg, for example, expect us to be done. So the most likely scenario is that we are done this afternoon. But there would be still some room for surprise. As you mentioned, Bullard was opposed to it. And even though this is highly unlikely, there's another option, too, that they say we're going to taper, but just not the full 15 billion. We'll taper by 10, and we'll leave that little bit until December. But that's really kind of a risk scenario and not likely to happen.
5-year break-evens, 5-year break-evens, 1.54 this morning. 5-year, 5 years, 2.31. Is there an inflation story here that we need to worry about in the States that would project us towards some sort of interest rate hike?
Well, essentially, the inflation expectations are the reason that Bullard, for example, has been opposed to full tapering, and he's been looking more at the short-term inflation expectations, such as inflation-protected government bonds. They have declined recently, so that's his argument for holding a little bit. And if anything, inflation provides some reason for being a bit dovish, which is why so much attention will be on his statement and how they word the inflation situation.
This is oil prices, right? I mean, we've been undershooting inflation because oil prices, which is completely out of their control.
I'm not sure it is oil prices. I'm not sure it is oil prices. Most major central banks at the moment are below their target on inflation.
If you look at the U.S., for example, core and headline inflation are both at 1.7%. So even once you strip out those oil prices, you have the same exact reading on inflation. So it's not really entirely an oil story, even if you look at the Eurozone.
But they're a big contributor.
It's a big contributor. For example, if you look at the Eurozone, headline inflation is 0.3, and the core is higher than that. So there is some influence from a drop in oil, but it's not entirely an oil story.
Wages?
Wage growth just isn't there. Demand isn't where they would like it to be. I think when we talk about the end of QE, though, we've still got a Federal Reserve maintaining a balance sheet of $4 trillion.
ECB would love that.
Right, so there's you know, they're not saying they're letting maturing securities just fall off and watching the balance sheet decrease. There's no exit plan just yet. They haven't outlined that just yet. So they're still going to be maintaining a pretty large balance sheet. And I think the big issue as well is that you've had a Federal Reserve that's targeted two things. They have a dual mandate, as you know. It's price stability, it's inflation, and it's employment, it's jobs. But the third wheel over the last 5 years has been targeting asset prices, and they have been actively targeting asset prices. And let's be clear about this, that was the whole point of quantitative easing. It was to push asset prices up, to push yields down, to push you out into riskier places. I bring that up because that third wheel, does that just disappear? If you've been so deeply entrenched into your policy to target asset prices, when you pull back and asset prices move, are you pushed into a corner? Because over the last month or so, the Fed has looked terrified, and when the markets move, the markets push them into a corner.
But that's because of market volatility,
and
right?
Jim
They're
Bullard
terrified.
then came out and said, well, QE can stay on hold. Jim Bullard did that without a decline in any of the economic data we've seen on the job side of things, without a substantial decline in inflation. That was off the back of market volatility, pure and simple.
Right, but that's fair enough. I mean, you can't argue that they should ignore market volatility. Right? This is one of the things that they should be looking at, especially...
Tail and dog spring.
Exactly. That's the point, right? That's the point.
Right, but this is something that they should be watching out for, because actually the consequences, especially of this market volatility on the rest of the world, is very significant.
Well,
they haven't in the past.
It's not their mandate to worry about the rest
of the world.
They are increasingly worried about the rest of the world.
Should it be? If you have the emerging markets knocking on your door and saying, sure, it's domestic policy,
Fed's mandate is the US...
but you're putting me in trouble, then it's something that they should be thinking about. My view.
Yeah, not the mandate. The ECB's not mandated to worry about what happens
nor is growth
in the
a
UK.
mandate.
No,
in the EU, and they've always managed to
I
work
take your
around
point
it.
that they need to take it tangentially.
Yeah.
What's central, David, to the Fed's thinking right now? Is it the concern about inflation? Is it the job story looks fairly stable? The growth story is something of a concern to Fran's point, and the global growth impact. The US is a relatively closed economy, but global growth still matters. What is it that they're thinking about right now? What will delay that rate hike?
Well, I think it all comes back to their dual mandate, as you mentioned. So the primary things they're looking at are inflation and unemployment. In the U.S., the unemployment rate has dropped to 5.9%. And so really the key worry there is inflation. It's still under their kind of de facto target of 2%. And as you mentioned, inflation expectations declining. So that's really kind of the case for the doves right there. And I think the international story isn't going to play on their minds as much as some might think.
For Stanley Fisher.
This is an old debate. Should the Fed take into...
It's not a global central bank.
Yeah, exactly.
If I look at the wider U numbers on participation, how much slack do they think is in the economy? The participation rate in the States stinks. Yeah, the unemployment number's lower, but if you take a more finessed argument surrounding it and take a look at the wider measures of employment, is there a sense that there is still considerable slack? If you listen to Summers, if you listen to people like him talk about the productive power of the United States economy, he's deeply concerned. To what extent is that going to be influencing thinking within the Fed?
It's going to be a huge thing, and that's one of the reasons that the market's going to be so focused on that statement. The phrase they had was there's a significant underutilization of labor resources in the United States, and so there will be a focus whether that's retained today, and that's a reflection of the fact that, as you said, even though the unemployment rate is low, there's still slack there. If they want to become a bit more hawkish because of the most recent decline, they could, for example, drop the word significant, and that would be a key, but that's not really expected by most people.
Okay.